All right, guys. So it's almost 5 p.m. So we're gonna go ahead and get started. Couple of house rules. Uh, we are going to keep the microphones muted to avoid some background noise, and we are going to do a Q&A towards the end. So if you have any questions, please type them on the chat room. We'll try to get to all the questions. If we don't get to your question, then we'll probably do a one-on-one later on. My lovely wife is on the chat room also, so she'll be able to try to answer some of the questions live. All right, there you go. All right, so my friend Brady is going to walk us through the presentation. This is the presentation for Parchment Manor. Is 41 units in the city of Parchment in Michigan. Before we get into the presentation, I just wanted to talk to you guys a little bit of how we got this property under contract. As some of you guys know, some of you that are on this call, it takes a lot of work to get an offer accepted when you're trying to buy an apartment building. The brokers and sellers, they don't just look at you and your finances, they look at your team, your contacts, your experience, your portfolio, your knowledge of the area, and you're competing against people that have 500 1,000 doors under their belt. So it's very difficult, to say the least. I think before we got this one, I think in the last year, I think I put roughly about 14 or 15 offers myself, with my friends, of course. So this property is currently owned by a corporation. They own and manage about 5,000 units. Uh, when I first talked to one of the owners in April, he said that they were planning on getting rid of their smaller properties. So for them, anything under 100 units is considered small, because they manage other apartment buildings that have 200, 300, 400 units. So they were going to sell their smaller properties and just move their money to different type of investments and focus on the bigger properties. So that being said, we looked at the numbers. The property was listed for a higher price, and the numbers just didn't work for us. Months went by. We kept looking at these properties and other of their properties, and we put an offer on one, and we were completely outbid because another group purchased all four, including this one, as a package for like roughly about 7 or 7.1 million. So there went our opportunity to buy this one. But about 30 days later, 20 something days later, we received a call that I guess the transaction didn't go through and the properties were going back on the market. So we contacted the seller again. And after a couple of weeks of negotiation, we ran our numbers. We knew that we couldn't come in at the 2.14 price. And the seller said, hey, send me what you have. And we were lucky enough to get the property for 1.85. So it's roughly about $300,000 off the asking price. So but today we're presenting this, and it's basically since April that we have been working on trying to get this property in or another property in this area. So with that being said, I'll hand it off to Brady so he can get started on the presentation.
Yeah, well, before you do, Mauricio, how about you just go through the team real quick, and since you assembled this crew.
The awesome team at Brickstone Investments. And it's there's my boss, which is my wife Princess, as you guys know. We have Steve Ta, who is a local investor, my friend Diana, who is a loan officer. We've been working together for the past 4 years. David Verga, who is on the call, of course. A lot of you guys already know him. He is our boots on the ground. David actually drove by this property before we put in, like 3 or 4 months ago, before we put an offer on this one. He drove, but I think like 4 or 5 different properties, took pictures, took notes. So just to give you an idea that the amount of work that has gone into this. And of course, Brady, he is in North Carolina. He is a great part of our team. He's great with numbers. He looks at everything not 2 or 3 or 4 times, but probably 17, anywhere between 17 to 60 times. So that being said, go ahead.
Yeah, thanks, Mauricio. Yeah, so there is a disclaimer associated with this. It got extended in a previous phone call with one of our lawyers. I do recommend that you read through it before, as you consider the opportunity that we have here, guys. So we wanted to start off with 3 key takeaways. I think the first one is obvious. We're in the middle of a pandemic, and that pandemic has affected everything. It's affected all businesses. It's affected real estate. It's affected apartment buildings as well. We recognize that, and we also want to talk about it because it's affected every business differently. And certain asset classes stand out from others as to the limited impact that the pandemic's had on it, and others obviously stand out for other reasons because they're enormously impacted.
That's right.
We'll talk more about this in a little later in the presentation, but if this makes you nervous, or if there's any point in here that you see something and you really want a follow-up question, type it in the chat box, as Mauricio said in the beginning. If we don't get to it today, we can always set up like one-on-ones later. The other points are really good news. This investment opportunity projects almost 16% average annual return over the course of 7 years. It's a really strong investment. Also with multifamily, I know that some investors may not have invested in the multifamily side of real estate before, but you do get those same tax benefits. They pass through to the investor. And so you don't get the opportunity to miss out on those. You get the opportunity to take advantage of them
Exactly.
in a big way. Of course, I'm not your tax advisor. You should talk to your tax advisor on that. It's only my personal opinion, but it's a good opinion. Yeah. So let's jump into it here. So the investment overview, and we'll go and obviously into more detail on this. It's 41 units. It's in a city called Parchment, Michigan, and it's located just outside of Kalamazoo. If you know Kalamazoo, then you know where this is located. Purchase price, as Mauricio said, was around 1.85 million. The total capital that we're raising for this investment is 775,000. Yeah, average annualized return almost 16%. IRR is around 13%, and the equity multiple is 2 roughly. Yeah. The hold period that we're talking about is 7 years, so investors should be planning to have their money in the investment for that full duration. And then, of course, the minimum investment I think has already been communicated to everyone via email. But overall, I would say it's a low entry into multifamily real estate. In most opportunities that I've seen and am invested in, you see it around 50,000 as your minimum. In this opportunity, it really is a lower threshold. We did that on purpose. And of course, the maximum investment is around 200,000 because we want to open this up to multiple people and not just one person coming in. Yeah.
That goes for Steve.
That's right. No hogging the opportunity. MTH Management, we know them well because actually one of our mentors uses this management company. This is a third-party property manager. They've been in the business for quite some time, and they're really good at what they do. They're currently managing the property already, and we will keep them on because they are good at what they do. So the opportunities that we're going to present here from the shortfallings of let's call it the past property system that was in place is primarily due to the ownership, not necessarily the management, because we know this management company. That was one of the huge benefits going in, is we didn't have to question, let's say, the backbones of how it was being done, because we already know the management company. So it brings a lot of credibility when you go into a deal and you know the people that are running the show. Overall, multifamily properties, yeah, why do they make sense in comparison with some others? There's lots of things we could say. I tend to cook it down into, where are people going and where's the money going, if you will, and how are they stable through bad times? Yeah. Mm-hmm. So if you look over the last decade, People have to have a place to live. That's the bottom line. And more, we see people going into rental space versus home ownership. Not only is that true just in general, but if you look at the generational splits, generationally, the younger people tend to be moving into apartments or into the rental community, if you will, more so than past generations. So all of that's goodness in the direction of owning an investment property, owning a multifamily property. I mentioned COVID in the beginning as one of the first, topics. And I think it's a good reality check to always go back to where are the numbers? Yeah, and these are nationwide numbers. I know every market's different. We'll actually talk a little bit about this market in a little bit. But it's very encouraging when we do talk about this market. But nationally, even compared to last November, yeah, which was of course before the pandemic, we're really only off in rent collections by 1.6 percent points. It's pretty good compared to the doom and gloom that you're hearing on the television. And I will say it's very market dependent. I know, New York's different than Michigan and North Carolina and all these other places, but this is a national average, and it's pretty good when you compare that national average to the trends of other investment assets. Yeah. So let's talk a little bit about the area: Kalamazoo, Portage, and Parchment. Yeah. So the Kalamazoo Portage, they call it the MSA, which is really the region around the area where we're investing. Yeah. A little bit about it. So all these are photos from there. If you can see it, depending on the size of your screen, if you can see it down in the bottom left corner, that's a map of Kalamazoo, and you see the lighter shaded area up at the very top. It has a nice little green tree on it. That's Parchment. So Parchment is really almost a suburb of Kalamazoo. Kalamazoo and Portage are kind of the hub economically, if you will. And Parchment is a town that Kalamazoo's kind of grown up around, right? And so it gets to take advantage of all of that economic goodness that's surrounding it. In fact, it's hard to tell on a map, but it's only a few minutes from downtown. It's maybe 10 minutes from downtown. It's about 10 minutes from the university, I guess, which is just past downtown. So it's really close. There's a lot of goodness in that area, and we'll talk about that here. Yeah. So in this area, they've been pretty focused. There's a lot of things that you could pull. I tended to focus on the redevelopment that's going on because that's going to play into Parchment specifically. Yeah. So in Kalamazoo, there's an organization there. It's called Brownfield Development Organization or something like this. But they focus on taking some of these properties that maybe have fallen behind, if you will, yeah, for the city plan, and they focus on how do we get that property rejuvenated, refurbished, and up to today's standards, and start attracting more income into the area. So they've done this with an old creamery. They've done this there was a historic Messianic temple, and overall they're doing this throughout the entire county. And Parchment is included in that. So overall in this, what we call the MSA, which is what I would term as kind of the economic stability of the region, you have about 300,000, a little over 300,000 people. You do have some big players in the area. You've got, Pfizer, which is all over the news now. In fact, I would add, you see the trucks coming through the news. That's Kalamazoo. You may not realize it, but you're looking at the city.
I'll add to that, because Steve was the one who mentioned, and I saw the videos of the trucks leaving the factory and people outside waving. That's 8.6 or 8.8 miles away from this property.
That's right. Yeah, it's actually Pfizer's largest manufacturing facility in the world is right there. Another, continuing on the medical field, Stryker Corporation's there as well. Stryker, if you don't know them, is the world's largest corporation making medical devices, implants, and so on. In fact, if you look at their total employee base, about 10% of their global employee base, roughly is there in this area. There's of course other industries, but since that's on the news, that was the most relevant, so I pulled it. Some other things, a little bit about the city of Parchment. So I mentioned to you there's this organization called it's on the screen, Kalamazoo County Brownfield Redevelopment Authority. That's a mouthful. What they do is they take opportunities that are out there and that need redevelopment, and they focus on it. They look at how do they partner with other businesses, with other commercial developments, however they need to do it with the state level, to infill these properties, redevelop them, and get and get them up and running again. The thing about the city of Parchment is, if you looked at its border on that map, which I know was a while back and pretty small, but it's really confined within the city limits. In fact, there's no real development land in there anymore. Every portion of land has been developed, or it's designated as a park, with the exception of this very large 80-acre mill site. There used to be an old paper mill there. The paper mill doesn't exist anymore. The buildings are there, and it's a huge opportunity for Parchment. In fact, they had someone in the past that had purchased the land and they were going to redevelop it. They did not follow through with their end of it, and so the city of Parchment bought it back from them. And so now they've taken it into their hands. They own the property. They've engaged this organization, the Redevelopment Authority, and they've already got plans underway. In fact, you can go to the city website and you can download their City of Parchment master plan. Yeah. And I put the quote there at the bottom from that master plan. It's about 40-something pages long if you care to peruse it. But in general, their focus is going to be the redeveloping of this area to make it a stronger hub for both economically and socially. So they're going to have mixed use buildings. They've already started some of that development. In the southern portion of it, they've already got some warehouses that are going in, or some commercial buildings, and they're also working on the northern end, and they're working on plans today with existing companies in the area for what are they going to do with the other buildings that are already there. Some of them need to get torn down, how and when, and so on. So the bottom line is, the reason I go into so much detail into that is because that is the development land of that city. Yeah, there's no more places to develop, and they're really focused on it. And I'm encouraged that they have a plan about it. We talked to the city manager about it. They've got good things in the future, and that's very encouraging for us, because our apartment community is I think really a block away. It's like one street away from that land and where they're going to do this development. They also have a lot of festivals there inside of Parchment. They have an enormous park gathering facility. It's not too far from the university. There's 3 universities or 3 colleges there in Kalamazoo overall. Our building is about 10 minutes from Western Michigan University. I mentioned I talk about the rental market there. This is from Rent Cafe. You can go onto their website and see these same numbers and same charts. In general, so at the top right, if you see that, this is the range of rents in the area. We'll show you our underwriting here in a minute. Some of you may have already looked at it online, but we're in the lower end of this spectrum. And it's goodness for us, because the more demand that you get in Kalamazoo, the more people start looking for opportunities elsewhere. Yeah. So these are all based on Kalamazoo, Michigan apartment rents. And the higher the rent go there, the more opportunities people look for surrounding areas that are stable and in good places to live. And from talking with the tax assessor there, we did talk to them. Finally, I would say, Mauricio, we did talk to them. And from talking to them, Parchment is actually a very active area. I didn't know this, but it was a very active area for home sales. It's about 80 to 100 home sales a year in that area. And he had mentioned that it's an attractive area because it has that small town feel, but it's right on the side of Kalamazoo. So they get the Kalamazoo benefits, and they get to feel like they're living in a small town at the same time. That being said, the rental trends there are very strong. You can see the rest of Detroit there. I put the numbers in. Kalamazoo and Portage, which is kind of that market that we're living in is around that 6%, 5% range for this year. If you're curious what it's been for past years, maybe it's a fluke. And I would say I wouldn't always count on 5% and 6% rental increases in a market. But in general, 2018, 19, and 20, it's been at least a good trend. Yeah. We've underwritten this deal at a rental inflation of about 2% per year. Yeah, except for the first 2 years when we stabilize it, the future years are at 2%. So we're pretty conservative there. And that's why I put this in here. One is so you can get a feel for the market. The other one is so you can get a feel for what we've done in the underwriting to make sure that we're prepared in case something happens in the market in the future. Yeah. So we're not counting on these. We're using them, one as a gut feel check, but two as what could we realistically expect in the future. Yeah. So business plan. What are we going to do with this asset? So the property itself, I'd mentioned earlier, the management company that's in place is actually very good. They have a very good handle on Southwest Michigan. They own a lot of properties there. We know people that MTH is managing their properties, and they do a good job. The issue with this property has been really it's deferred maintenance. It's been long overdue. If you look at the roof, it's been patched multiple times. Yeah. And the ownership just did not want to invest in the property. I think, Mauricio, if you told me correct, I think you mentioned at the beginning, right? It's one of their smaller properties that they had in this portfolio.
Yeah.
And they really just didn't pay attention to it.
Yeah, that's what the property manager said at MTH. He has been a key to this whole operation because he knows these properties very well. So he's been the one giving us information about these properties. We looked at several other ones. One was called Eagles Landing. Another one was Humphrey Woods, and he would tell us this property is not in a good neighborhood. This property needs way too much work. So he told us that this property, the owners, they're dumping money on the bigger properties. They have one property that is 468 units in Ann Arbor, which is one of the most famous cities in Michigan. So they focus on those type of properties. On these, they just kind of let it go, and it just starts building up. So what it's done is that it's created an opportunity for us.
That's right. So we plan to take advantage of that. The outside curb appeal needs a little bit of refreshing as well for the same reasons. The ownership just really haven't kept it up that much. It's led to a lot of higher than normal maintenance in the property, and a lot of complaints, from the tenants. So MTH management, I mentioned all of their experience that they have. Based on what they know about the market, along with fixing all the deferred maintenance, especially the roof. We do expect to improve the tenant base there and lower the vacancy. They've really struggled with vacancy over the last year. That's good for us because there's no reason it should in this market if you have if you're not just not fixing up the building. Yeah, if it's a rentable property, it should do very well in this area. So if you solve those things, the vacancy should improve. Yeah, and so two things we're going to do from in essence property takeover is we got to fix the roof. We got to do some outside stuff with the fascia, a little bit of signage. There's some minor improvements inside, but through all of these, that's how we plan to improve the retention of the residents there. And we've staggered our rent growth over 2 years. We'll of course, attempt to do that sooner, as soon as we finish the roof. Yeah. And we start to get, better tenants in there, or at least to fill in the vacancies that are in there. We've spread it out over 2 years, but we feel like that's probably a little conservative right now. But that's how we've modeled it. Additionally, there is one down unit that's not being rented at all. It's not rentable. It's actually down to the studs. The previous ownership had started it at one point and they never finished it. So we're going to finish off that unit, get it rentable, increase the income and the value of the asset overall. Yeah. Other than that, there's really very minor repairs. It's a C-class property. This is not a strong value add property. We're not going to go into every single unit, put granite countertops in with new, you know, you know, with new
Lights,
everything.
paint,
This is
yeah,
not that play.
floors,
This
yeah.
is we're going to get it stabilized. We're going to get a good tenant base in. You know, we're going to get it looking nice, rentable, and you know, it's going to perform very well like that.
Yeah.
Yeah.
I wanted to mention something, Brady, real quick. As of April of this year, that's when they put the property on the market, or at least when they started mentioning that they were going to sell the property. The vacancy was 0% back in April. And since then, they just kind of neglected it, and it's created a lot of unnecessary vacancies. But the property has the potential to operate at a very, very low vacancy rate.
So let's get into the underwriting a little bit here. So a little bit more about the property. It was built in the late 60s. Yeah, I mentioned already, it's a Class C. It's a garden style. It's a two-story building. It's actually two-story buildings right next to each other. It's on a corner. It's got good visibility. It's basically on the main business street of Parchment. This is going to be, you know, tenants, you know, working class community. This is your American workforce people that are going to be renting these units. Yeah. A little bit more. There's a unit mix over here. Primarily, this is 1 bed, 1 bath. There is a couple of 1 bed, 2 baths, 2 bed, 1 bath mixed in there, and a couple of studios. But primarily, this is 1 bed, 1 bath units that are in this property. So what are we going to do with the CapEx? So we've got 200,000 in CapEx. Primarily, that's going to be exterior. The interior does need some improvements. It does need some upkeep. Yeah, I mentioned the one offline unit. That's going to consume most of the interior budget that we have. There's other minor repairs based upon the inspections that we completed. And then there is some upgrade to the electrical service in one of the buildings. In the photo that you see on the screen is actually just to the left of it. But there is some electrical service in one of the buildings that needs to be updated. It's very minor. It's you know, it's not a big deal. Exterior is really where most of the CapEx is going. It's got a flat roof. The whole thing needs to be replaced. I already mentioned the fascia. It's got a couple other minor things. You know, it's got some exposed wood. We need to strip it, and we need to repaint it. These types of things. And of course, the new signage really is in need of some new curb appeal on the property. You
know, I wanted to add something real quick.
Go ahead.
West, he asked, have the increasing cost of construction been taken into consideration? Yes, they have actually to replace the roof. The original quote we had was from the spring, so the roofer was at the property on Monday to give us a more updated quote.
Mm-hmm. Yeah. So, Derek, I think you asked a question as well back when we were talking about the market. Yeah, sorry, I couldn't think of the word. Back when we were talking about the market, you'd asked about population growth over time. Because the city boundaries don't allow really for any new development, the city of Parchment itself, if you look at its population growth, it's pretty stable, if you will, because there's no room to redevelop, right? They're not building any new buildings, right? You're just, someone moves out, someone else moves in. So we look at the area of Kalamazoo for your question for, you know, where's population growth going? And over time, so over the last, I can't give you a percentage. I could maybe follow up with you, but if you look over the last, I would say, you know, from 2010 to 2017, you know, it grew, the city of or I guess let's look at Kalamazoo County really. It did grow by roughly maybe 5%. I can give you the real number later. I just eyeballed it, but so there is population growth in there. if you look at that MSA, you're going to see that there's a lot of attention to attracting business. Yeah. And it's been very purposeful. You know, people that know Kalamazoo know that it's a good place to be. It really is. And the population responds accordingly to that. You know? So hope that answers your question. As we get into the underwriting, again, depending on if you're on a phone or what, you may not be able to see this. That's fine. If you got detailed questions, just reach out to one of us, you know, and we'd be happy to walk through it. I'm not going to go through all these numbers and bring people through the pain and suffering of that. But what I will do is I want to point out a few things in where we've you know, where some of the key attributes, if you will. Yeah. So through talking with the property manager, we feel confident that we're going to be able to raise rents $25 a year on average. What we've done is we've assumed that $25 a year is going to come in year 2 and 3. Yeah. To spread that out, to add in a little bit of conservatism, just in case, you know, we're wrong, right? It spreads it out a bit. What we've also done, as I mentioned previously, this rent escalator. Yeah. It's almost an inflation percent, if you will. Yeah. We apply that both to the rent or the income as well as to expenses. Yeah. Year over year. And so we've kept it really low, and we've done that throughout all of our underwriting during the middle of COVID, simply because it's smart to do. You don't know what's going to happen next year. I mean, who would have predicted a pandemic? So it's a smart thing to do. It's also somewhat conservative. I showed you the last 3 years of rent growth in Kalamazoo area, and it was, if I remember right, it was 5 point something percent, 3 point something percent, and 6 point something percent. Yeah, on average, maybe it was around 5%. Yeah, we're taking a more conservative approach and saying, well, we can't predict the future. We don't know the market, what it's going to do, you know, 3 years from now. So let's leave it at 2. The other things we've done is in the first year, we're taking 15% vacancy assumption. Yeah, and I scanned past it briefly there. Perhaps Mauricio, you can give me a nod if I'm answering it correctly from the chat there. But I think someone asked something about COVID. What are you doing for COVID? And how are we kind of mitigating that, if I glanced at it correctly?
That was the question about the cost.
Say that again. Which cost?
The cost of maintenance and repairs. And what the difference was between before and after COVID.
What the difference was in the repairs and maintenance before and after COVID.
Yeah, so the cost of renovations as well.
Yeah, if I'm understanding the question correctly, I don't know if it's so much related to COVID as much as it is just this deferred maintenance. The deferred maintenance is really what's driving the overall maintenance of the property. Yeah, and so you'll see here, repairs and maintenance, if I remember right, it was around 10,000 more than what it should be for a property like this. Give me a nod, Mauricio, if you remember that too. Yeah, I don't have it in here, but it was around $10,000 more than where we'd expect it to be. The good news on, you know, how are we confident in our repairs and maintenance number? Maybe that's another question that's kind of buried in there. And we can be confident in it because, one, our property manager is managing many assets exactly like this one in the area. Yeah, he has a very good feel for if it's a C-class property, if it's located here, you know, very typically it's this maintenance. Yeah, I'd also say we're starting from day one with a reserve of capital of 41,000. Yeah. We're putting that in up front from the time we take over the property. That capital reserve is in there in case we've missed something in the inspections. Yeah, we did a very detailed inspection. We walked every unit. You know, we got on the roofs. We did the details. But in case we missed something, there's another 41,000 from day one that's available to go resolve that. Yeah, but typically we would expect repairs and maintenance to be around this number for this age of property. And for this class of property in this area, you know. So going back to, you know, some other things that we've taken into consideration, because we're living in the world that we're living in today. Yeah. And there's a lot of uncertainty. Fortunately, there's a vaccine out there, but that's not solving everything in January, right? So the approach that we've taken is we're going forward with 15% vacancy in the first year. We drop that down to, or I should say 15% economic vacancy, if you will. Yeah, accounting for bad debt and these types of things, concessions. And then downstream of that, we're going to 10%. And then later on, we're stabilizing that value at 5% vacancy, 2% for bad lease and concessions. Yeah, which is typical for this area, according to the property manager. So we're really taking 3 years to get to what we're calling a stabilized property in the underwriting. Now, in reality, that's not our plan, right? But in the underwriting, to be a little bit conservative, because we don't know what's going to happen. We don't know between now and June, what's going to happen. But we do know that, it's smart to put in a little bit extra and not count on every ounce of income that the property could produce. So we've done that. The other things that are maybe not as transparent, we modeled in some real estate tax increases. We went a little bit higher than what we should. We found out it's probably roughly maybe 10% too high, or a little bit more, according to the tax assessor. We were able to talk to the tax assessor. He reassured us where the property taxes would be. We expect property taxes next year to be around 29,000. And we've modeled it in around 35,000. Somewhere between 29 to 30,000 is where we expect it to be. So there's a bit of conservatism in there. We chose to leave it in for one reason, and that is until we stabilize the property, we want some margins in there. And that's one of the ones that we've just left in. The rest of this, I'm not going to go through every detail of this. I would highly encourage you that if you're a numbers person and you want to dig into the details and you want to ask the specific questions, set up a time you could set up a time with me, even if you don't know me, or Mauricio or Dave or anybody, and we're happy to walk through it with you. In the chat, was there any other questions specific to this slide, knowing that we're talking about returns on the next one, Mauricio?
Yeah, let's go to the fun stuff.
Okay, let's talk about money. So projected returns, I've kind of split it a little bit on the screen. Hopefully, you can follow through with it. On the left, you've got the projected investor returns, and we took the approach of, if you've invested $50,000, what would it look like? And those returns you can see there on that right chart. See projected returns, and you see a blue number on the top, 50,000. So these are the projected returns as we have modeled it on that previous page, including all the assumptions I mentioned, and what you could expect over time. And that leads us to the average annual return that we're projecting going forward of close to 16%, internal rate of return around 13%, and the equity multiple of 2.1. And you'll notice in the first 3 years, the income, or the first 2 years, I should say, the income's a little bit lower, or the return on your investment's a little bit lower. Primarily, this is due to, if you remember, when in our underwriting, we're escalating rents. We're not escalating rents until the second year, and then the third year. And we've built in 15% vacancy up front in our underwriting, because it's a smart thing to do right now in the current pandemic. The ownership splits that we've put in to this offer is 75% to the investors, or the Class A limited partners, and then 25% to the general partners. Overall, I will say that the general partners are investing over $200,000 into this opportunity. We see this as a good opportunity for ourselves. Mauricio kind of glazed through the beginning of it, and how he found the property and how it went away and then it came back, and we worked with the property manager, and we talked about all these other properties. The bottom line is, when this came back, and when I really, Mauricio's too humble of a guy to say it himself, but I really credit him for how he was able to get the price to where it is. We started at 2.1 million, we got down to 1.8. That's not by accident that happened. There was a lot of time and communication that went into it, and we recognize that this is a good investment, and we're putting our money into it. No question about it. Yeah. So it's a little bit about the returns. I see a couple of questions came in, but you've been looking at them more than I have, Mauricio. Is there anything specific to that we should
No,
answer on this page?
we can get to it towards the end.
Okay. All right. Let's do that. So summary of what you saw above, and we were intentionally, I would say, light on going through the underwriting. I know a lot of people like to dig into the numbers, but at the same time, it's probably better one-on-one. And some people don't need to dig into the numbers as much as others. So instead of investing all that time in this webinar, we really do want you to reach out. If you've got questions about why we did certain things, or let's say where are the margins, or even where are the risks, we've mentioned, the risks that we know about here, but if you have other questions like, well, did you think about this and did you think about that? If you haven't put it in the chat already, please reach out one-on-one to us. The summary of this is really, it's got decent returns. Decent's probably an understatement, but I'm told that I can't overspeak it. So
that's what we were told by our attorney yesterday.
That's right. We've got to be mellow about it. But it's got solid projected returns. Yeah. It's got solid internal rate of returns. I'll tell you, I did the sad evaluation on my own, where I personally went back and looked at my 401k from when I started investing in it back in 2000 until today. I have personally made, and some of you are going to realize, why I'm not investing in the stock market, but I personally have made in my 401k about 7% average annual return. So coming in at a 15 or almost a 16% average annual return is quite phenomenal. Yeah. It's a projected hold of 7 years. The reason we say projected hold is markets change. There's unpredictable natures of what's in front of us. We're going to watch the market. We're going to watch the situation. We're going to watch what's happening. And our plan is 7 years. If we get to 5 years and it looks like a phenomenal year to sell a property, we'll evaluate it, right? If we get to 7 years and we're in a downturn, we're going to evaluate that too. We're also going to look at, does it make sense to, do a refi somewhere? That's not off the table. It really depends on the market. It really depends on what terms you can get at that point in time. And that's also why we haven't modeled that in. But in general, projected 7-year hold, again, minimum investment of $25,000, maximum of $200,000. So next steps, where do we go from here? One, we're going to have some Q&A. We see your questions there, but just to lay out the next, several weeks going into February. February 4th is the closing date. So if you back off of there, our private placement memorandum, which is where the official offer, I would say, comes through. Yeah, this is kind of a summary of that offering, but the official offer always comes through that private placement memorandum, the PPM. That should be available here towards the end of December. We have our attorneys already working on it. We've already met with them, and they're already preparing that. That date's important because at that point, that's when you can start actually committing to the investment. Yeah. And so we've put out there that January 4th is when we're going to open this up for funding. And we're going to have that window open for about 2 weeks through January 18th. And at that time, funding will be closed, and we'll be marching in towards closing and closing on the property on February 4th. Yeah. So with that, I know there are questions because I've been seeing my side screen ping every once in a while. So I'm going to give it to you, Mauricio, because you've been reading them. And what are some of the questions, and how can we help you guys see more about this property?
Yeah, we wanted to keep this at 45 minutes, so we'll just take a few minutes to answer some of the questions. There's one that I saw from Micah that I wanted to answer because there's a story behind it. Would it be fair to project future maintenance might be less after the initial CapEx spent? The answer is yes. The property manager, in his words, he says that lately they have just been chasing the leak. So those are his terms, because the roof has been leaking, and it leaks on one side of the building, then it leaks on another side of the building. And the owner, instead of spending 100 grand replacing the roof, they had just been patching one side, and then it leaks on the other side. Um, so we saw the report of all the work orders, and a lot of it was related to leaks. So that's why once it's replaced for good, we do expect to see the expenses a lot lower.
Mhm.
And also, I saw something about rent control. I was probably behind, but I don't have the question in front of me. But what I can tell you guys is that according to the property manager, and not just him, but just people that we talked to over the past 7 or 8 months in Michigan, the property manager has says that if a tenant owes him $400, that's enough for him to evict them. So the laws are very, very different compared to where we are here in California. Let's see, very different, I would say. Scott plans to cash out, refinance. We did model that. We modeled it at year 4, a refinancing on year 4, and selling on year 7. It actually brings the cash on cash significantly higher, about 2 point something points. But we wanted to be conservative because we don't know how the market is going to be then. So that's why we didn't put that out there. Otherwise, the numbers would have looked a lot better. That is the plan. If we're able to do it, if the market conditions are good, then by all means, we will refinance, get a lot of the cash back, and just keep enjoying the cash flow for the next few years. Current turnover rate. The last few months have been very challenging for the property manager because, as he said, the owner is not really paying too much attention. Right now, there's 4, or I believe 4 or 5 vacant units, and the property doesn't perform that way. So the turnover rate the last few months has been a lot higher than it normally is. And I think that's any other questions, we will probably get to you guys one-on-one. Let's see. Yeah.
I think Rachel asked a question about the financing terms. We have, worked with the lender. We've locked those down, and yeah, so the vendor is secure. The terms are
Oh yeah,
agreed upon, and
my friend Kimberly was asking about the terms of the loan. So we were able to get 3.5, 3.75 interest rate fixed for 30 years. We're getting 70%
for
leverage.
25, yeah.
Oh, 25, yeah, 70% loan to value. We were able to get the capital expense budget approved, so we added that to the loan. So the total amount of the purchase price, which is 1.85 plus 200,000, and the loan is for 70% of that,
Mhm.
which is a pretty great. It only took us a few months to get to that point.
You make it sound so easy when you were presenting it, Mauricio. I got to
Yeah,
tell you,
yeah.
it's like,
Well,
yeah, we got this. But it is a pretty good loan. We did roll in the capital expense into it, and that of course helps our
yeah.
returns and helps the position, going in.
And just to summarize a little bit, I met the lender at a convention in San Diego. He's from Michigan, but he was here. I kept harassing his phone until he finally picked up. So I drove down there to meet him just for 5 minutes for coffee, and it ended up being over an hour meeting. I flew out there with Steve. I think we left like at midnight, and we got there at 3 a.m. our time, and we were there for 2 days. We met with the lender as well. We met a lot of the people in the team, and this lender has been a crucial part of the team because he knows the sellers, he knows the brokers, and they know him. So because of that, it's one of the reasons that they were willing to give us this property, because they know that with the people we were working with, and they knew that if they said, hey, these guys can close, then they took their word, not ours, because of their experience. So again, we went with the best that we can find. the best lender that we can find, the best property manager that we can find, the best attorney we can find. I was mentioning to someone on a call yesterday, definitely not the cheapest ones, but you get what you pay for. We went with the best in the industry. All my friends are laughing because yeah, we just have been wiring funds the past few days. But again, we wanted to have the best in the industry. We are going to do a cost segregation study as well, and we're going with the best person that we can find, which is someone who works for a firm that has done about $3 billion in business. And the SEC attorney is an attorney that I met him in person in Texas last year, and then I saw him again at another convention in Virginia. And I see him all over the place. He's definitely not the most affordable, but he is the best. At least we believe he's the best because of the reputation, testimonials, and these are people that have done business with our friends. When I mention our friends, I'm meaning people that have hundreds, if not thousands of units under their belt. And if they trust them, that's how we feel that we can trust them ourselves as well.
Mhm.
Last thing, if you could, sorry, I'm getting a spam call. Put your email address so that we can send you a copy of the recording of this call. And that's it. That's all I have. Thank you everyone for joining. Very glad you could make it. We'll be sending this to all of our friends who weren't able to make it. I know it's tough on a Thursday at this time of the day. But again, thank you everyone. And if you have any questions, please reach out to Brady, David, myself, Steve, Diana, or my wife and I. Thank you guys.
See you guys. Thank y'all for joining.